most people don't understand a lot of what's going on. Certainly when we come out of the womb, we're not going to understand how a big, large corporation operates. It's something we've got to learn about. And unfortunately, most people don't ever learn about that if they study economics, because they basically assume it away by saying, oh, that large corporation is just a market imperfection and it's just impinging on the free flow of markets. Well, I basically don't see things that way.
My money.
I get money from you.
Money in the bank.
Young money.
It's a rich man's world.
I grew up in Toronto, and then I went to the University of Toronto, and it was about 4 years in the late 60s and beginning of the 70s where I was basically studying in 4 countries in 4 years. Canada, the UK, Switzerland, where I wasn't really studying. I was going skiing most of the time, but I was mostly studying. And then I ended up at Harvard in 1970 as in a PhD in economics. And along the way, I became, I'd studied by that time, even by the time I started doing a PhD in economics, a whole lot of economics, starting from an initial undergraduate course using Paul Samuelson's textbook, which of course was the textbook that came to dominate in economics courses, and clones of it still do. And I'll come back to that because that's actually relevant. But by the time I came to do a PhD in economics, I was certainly critical of most of the economics profession. Over time, I've learned why I was critical. And it's confirmed my skepticism, my criticism, the more work I've done, although it's not necessarily all the answers that, the answers that I found out about how the economy works are ones that I arrived out by studying the economy. So, and basically the approach that I've taken, which is not the approach that certainly that most economists take, and I'm not sure all social scientists take, is basically that what we do as an academic is we integrate facts and logic. And so we have to know what we're talking about, and then we have to try to figure out the logic of what we're talking about as a way of explaining things. And of course, one of the things that you may learn or you may not learn, certainly most economists are taught that it's not the case, that you need to know about how things unfold historically, because basically, this is one of my initial critiques of economics, it just takes a historical view of things and just says there's some set of principles about how people interact in an economy through exchange that is universal everywhere. And that's not true. So we have had enormous transformations in the way the economy operates, and the types of organizations through which the economy operates, the kind of technologies, obviously, and that needs to be understood. So basically, we said before, most people don't understand a lot of what's going on. Certainly when we come out of the womb, we're not going to understand how a big, large corporation operates. It's something we've got to learn about. And unfortunately, most people don't ever learn about that if they study economics, because they basically assume it away by saying, oh, that large corporation is just a market imperfection and it's just impinging on the free flow of markets. Well, I basically don't see things that way. I see markets are really the outcome of organizations, and not just business organizations, but government agencies, and actually what households decide to do as organizations, because we have probably 110,000, a million households in the United States, about a little over 70 million family households, and those are organizations as well. And when we find that we have well-functioning or labor markets, that is, we can change jobs easily, there's lots of employment opportunity. When we can borrow money easily, there's a lot of finance available and things for us to do with it. Where we can choose what goods and services we want to buy. There's, we don't have to stand in line and in a queue to get them, and they're readily there. a developed market in these things and in products and labor and finance. It's not just because they're there, it's because there's some organizations that have created the productivity that, first of all, makes those goods and services available. So we have that choice, makes the employment opportunities available. So we're not just taking one job today, another job tomorrow, scrounging around looking what to do. We actually get some decent jobs that have careers. Yeah. And it turns out that when this is done well, when it's managed well, when there's organizations that develop the economy in this way and give us these markets, there's also lots of money available. So there's financial markets out there. But the big mistake that economists make is that they think that this is a cause of our prosperity rather than the result, and it is the result. And the ideology that it is the cause is a big problem, because you then don't understand the causes, and the causes are organization. So if you think of it, the market is all about individualism, individual actions, and we love markets because, in fact, we like that express our individualism. We can choose what job to take. No one's telling us. We can start a business. If we can borrow some money, we can go and buy what we want, when we want it, where we want it. But that freedom, let's say, is something that's a result, not the cause of economic development. And okay, so the cause is at one level the business organization. That's basically the fundamental unit that we rely upon to actually deliver these goods and services to us in the economy. And standing behind these business organizations are governments, which have various agencies, invest in infrastructure and knowledge, regulate the economy. And when these things work together, we actually can get development. And then you add in families that are able to get good jobs, invest in their children, lead healthy lives, and they interact. Of course, we rely heavily on government for that. Government's, public education is still what most people experience in the U.S. The roads, bridges, whatever, all kinds of knowledge, NIH funding of National Institutes of Health, of our life sciences infrastructure, etc. So I have come to call that those three kind of organizations interacting, the investment triad. And what do? They invest in productive capabilities. Okay, so back to my PhD in economics. That's really what I wanted to understand. I realized that if you're going to try to understand the economy, you're going to understand how we get high levels of productivity out of the economy. And economists don't have a theory of this. It turns out it's even worse than that. And this is something I only started articulating recently, even though, as I say, I took my first course using Samuelson's textbook in 1964-65. There's an article that I have on the website of the Institute for New Economic Thinking. It came out last January, and it's an argument I've been making a long time, but it's best articulated there. The title is the most productive firm the foundation of the most efficient economy? Okay, now, anybody who's taken introductory economics courses, microeconomics courses, studied the theory of the firm, believe it or not, that's what they were taught. And I won't spend all our time going into that, other than that is actually something I learned in my very first semester at college out of Samuelson's textbook, that the more unproductive the firm, the more efficient the economy. They call it perfect competition. And okay, you get a mindset that you are never going to understand the growth of the economy, particularly insofar as the growth of the economy is dependent on business enterprises that invest in productive capabilities, invest in the labor force, invest in new products and processes, innovation. And you're never going to understand when government works and when it doesn't work. So that if you want to have something, let's say like now, I'm just working on a paper on this now, the Green New Deal, and you don't say, what role is business going to play if government's going to make all this investment? It's not going to work. On the other hand, it's quite clear if you look at US history of anywhere around the world, where you have productivity of business enterprises, there's government making investments behind them. So another thing I learned as I went along in my career, that was that the role of the state was fundamental. And in the 1980s, by that time I was early 1980s, I was an associate professor of economics at Harvard. I stayed there for a while as on the faculty. And then I went in the late 90s, I was at Harvard Business School for a while, and then went to Barnard College of Columbia University in the late 90s, late 80s, early 90s, or as a professor of economics. And I started talking about not only about business enterprises that were innovative, which economists don't talk about, but the state that was developmental. And at that time in the 80s, everybody was looking at Japan, and rightly so, because Japan actually innovated in industries where the US had been strongest. It didn't take the US on in industries where it had been weakest, in automobiles, consumer electronics, memory chips, steel, machine tools. And
that was Edward Deming, the quality model. Am I correct?
Oh yeah, and there's all kinds of reasons for that, but actually Deming's reflected something that was absolutely fundamental. What the Japanese did was they took the organizational structure that drove the productivity of the U.S. economy, and that is building managerial organizations that had engineers and managers and research labs, and drove the development of the economy, and then did mass production on that basis. And this, by the way, I was very influenced by the business historian Alfred Chandler, who I worked with a lot in the 1980s. He was at Harvard Business School, and was his major book was 1977, The Visible Hand, The Managerial Revolution in American Business, which won the Pulitzer Prize for History that year. And basically, he stressed the visible hand of business organization, but not basically as saying, oh, it's a bunch of monopolies, but it's actually driving productivity. And then when you looked at who gained from that productivity, in fact, a lot of people gained from that productivity in the post-World War II decades, but including a lot of people who had high school educations, blue-collar workers doing mass production jobs, until the Japanese came along. And basically what the Japanese did is that they had even more powerful managerial organizations, and they extended that skill and learning in what I call organizational integration and organizational learning to the shop floor. So they had a lot of capability on the shop floor. There was still a distinctive set of people who were blue-collar workers rather than white-collar workers, shop floor workers rather than engineers, but they were interacting in terms of improving the quality of the product, including improving the flow of the product, getting defects out of products. And actually that was what Deming was all about. Deming was a student of a guy named Shewart, who had been at Bell Labs in the 1930s doing statistical quality control. And Deming ended up in Japan really as a result of after World War II with the US Department of Agriculture and the recovery of Japan, and gave some lectures about implementing statistical quality control, which was put out in a book which became famous in Japan. They gave out the Deming Prize.
Yeah.
But basically what happened was, what he was arguing could work in Japan, but it couldn't work in the United States, because you had to, the engineers who were designing the production processes and had to basically get the participation of people on the shop floor in terms of actually improving the productivity of the shop floor, and in many ways helping to automate the shop floor. So Japan is a leader in robotics. And that's not because they were trying to get rid of workers, it's because they had workers who had a lot of skill, and permanent employment, and cooperated in the developing of these advanced technologies. So you couldn't do that in the United States. You still can't do it in the United States. And so the United States has abandoned a lot of that kind of manufacturing. Of course, Japan has had to a large extent too, as you have development of manufacturing in other parts of East Asia, particularly. But Japan has a uniformly highly educated labor force and very low birth rate and very little immigration. So they've been able to actually keep people productively employed, although they're not the leader in every industry now. But in the United States, we had this kind of division between management and labor. And in the 80s, what I watched was basically that division play out, where rather than respond to the Japanese by trying to perfect the US model, learning from the Japanese, and a lot of companies tried to do this, they basically let go of a lot of that manufacturing. At the same time, we had certain areas in which the United States excelled, particularly where you could segment off the design of products and the development of the technologies from mass production. And that's basically what I call the new economy business model. Let's say a company like Apple, with the design of its products in the United States and its mass production in China. That became much more of the model, and that was fine for a highly educated segment of the labor force, but it actually left a lot of the American labor force behind. And one of the things that I'm just finishing, I've got a couple papers out, which are chapters of a book, which are on, again, the website of the Institute for New Economic Thinking, is on what's happened to African-American employment over the last 50 years. Because in the 60s and 70s, a lot of blacks moved into semi-skilled blue-collar jobs, which are unionized, that paid quite well. And this was in the 50s and 60s for white males with no more than high school educations. This was a platform for intergenerational mobility. They would make good incomes. Public universities were practically free. There was all kinds of support. Of course, there was the GI Bill after World War II, which benefited whites much more than blacks, actually created more divide between white and blacks because of who could make use of it. That economy where you had this kind of secure employment with companies, which you had been before the 1980s and 90s, was pretty much a white man's world. Blacks started to move into it, but then that world fell apart.
And there is no, then one of the reasons why I'm talking to you, Bill, is that we've gone from a highly value-added engineering society to like one of financial engineering. And this is why, I want to have you on, because you're kind of the world's experts on stock buybacks, okay?
Yeah.
And so that's why I have... So could you tell people about the stock buybacks? Because it's really financial engineering.
Yeah. So the thing is, the history that I just talked about, you can't understand stock buybacks without understanding how innovative many companies in the U.S. economy were, how they, in a certain stage of their development, they shared the gains with their employees. They actually paid high taxes, but they still made a lot of profits, and they retained they paid pretty good dividends. Yep. But they reinvested the money in new products and processes. They rewarded their workers. They provided secure employment. Companies in the United States, which from the 50s and 60s and the 70s, they were providing the same kind of stable career employment as the Japanese were providing. That fell apart in the 80s and 90s and beyond. And what happened was that those profits are kind of like a pot of gold sitting in companies. And the question is, how are the companies going to use them? Now, they always paid good dividends, but buybacks were actually not something that companies did a whole lot.
They were illegal. They were illegal.
Well, they weren't really illegal. Here's the thing, that the First of all, companies understood that when they were profitable, which just means that their revenues were greater than their costs,
Yeah.
that gave them some finance that they controlled and that they could use for particular purposes. And as long as that particular purpose, and this is really much more a social norm as much as it was anything that was defined by law, as long as that was you keep your workers employed, you invest in the next round of innovative products, you try to have some growth of the firm, you don't just give that money away. Now, they usually would pay decent dividends and not like to cut dividends, mainly because they wanted shareholders just, keep quiet, don't bother us. But because shareholders are just people who buy and sell shares. That was true since the 1920s. So it didn't work perfectly, but that's a system that worked. And when you really do that, you can see it in a company like Apple or Amazon, or when you really get to the point where you have or Microsoft still, even with its Windows, even today, where you have a product that's really dominating the market, you're going to make a lot of profits. And so the question is, what do you do with them? And that's what changed, and that's where buybacks came in, because in the 1980s, there was an okay given both by the government and by academics that you can just take that money and buy back your shares. Okay, now it wasn't illegal, mainly because the regulator of the stock market is the SEC from the mid-30s. The SEC wasn't telling companies what they weren't really interested in capital formation or whether the company was investing in the next round of products and products. That wasn't its role. Its role was just to maintain a fair, liquid stock market for people who were buying and selling shares, which were mainly individuals. So they want to get rid of manipulation and fraud on financial markets. When it came to buybacks, they said, well, we really think that a company might be trying to manipulate its stock price, but it wasn't so much, and this means that they're not going to invest in the future. That wasn't the argument was made. It was simply that this could be fraud or manipulation. So in the 60s, the lawyers, and in the 70s, the lawyers at the SEC tried to figure out what to do about this. They actually had a proposal that was not adopted that would have allowed companies to do quite a bit of buybacks, but if they exceeded the amount that they would be charged with manipulation. That rule, it was called 13E2, it was proposed three times, I think it's 69, 73, and 80, and was never adopted. But when the SEC was really taken over by people that Reagan put in there, they got the rule that allowed companies to do the buybacks they do now, Rule 10b-18, which was adopted in November of 1982, which allows them to do much higher level of buybacks. I just did some calculations recently. According to that rule, on any given day, and Apple's an extreme case, Apple can now do about 3.5 billion in buybacks per day without exceeding the limit at which they could be charged with manipulation. Last October, that was about 1.5 billion, but with everybody piling into Apple stock, it's based on average daily trading volume of the stock price. A lot of companies can do 200, 300 million a day, large companies. They don't do that every day, but they can do it, and they can do it day after day, and they won't be charged with manipulation. It is manipulation, but they won't be charged with manipulation.
Okay.
And that basically was adopted in 1982. We have done a lot of research on this. I won't go into all the details at all, but because it take up too much time. But it's basically, we call it a license to loot. If companies on top of dividends wanted to just take all this money out, they now could do it, and that's what's basically happened. Now, when that rule was passed in 1982, you actually don't see people running around saying companies should be run to maximize shareholder value. There still was a notion that you ran companies for your employees, for your customers, and even the Business Roundtable, which formed in 1978 and 1981, had a stakeholder statement of the corporation. It's actually very similar to the one it adopted a year ago after going to a shareholder statement in 1997. Okay, so even the Business Roundtable, which was an association of CEOs, was saying, no, we're run for stakeholders. And they were actually trying to fend off Ralph Nader and the corporate social responsibility people at that point and say, no, we're doing, we're running for all our stakeholders. But the rules were being changed so that you could run this just for shareholders. Then what really changed things, and I was kind of in the room when it happened, between 1984 and 1986, I was on the faculty of Harvard Business School. And when I came there, I had spent 14 years before that, as I say, in where I'm living now, I'm still in Cambridge, across the river in the Harvard Economics Department. When I came to Harvard Business School in 1984, no one was talking about shareholder value. The people who were interested there really knew about companies investing in human resources, about the corporate finance was about reinvesting your retained earnings and not borrowing too much because you wanted to be able to sure you could pay it back. That was okay. That all changed in 1985, and I saw it happen when they hired a guy named Michael Jensen,
right?
Of course, of maximizing shareholder value. The dean of Harvard Business School, John MacArthur, the president of Harvard University, Derek Bach, went out of their way to recruit this guy to come in to say it's okay to loot companies.
Well,
and this was put for, okay. Now the important thing is this was put forward in the name of efficiency. The companies are inefficient; they're wasting resources. Put it out on the financial markets and allocate it to its best alternative uses. Now, that's what I learned in Samuelson's course without the shareholder value stuff in 1965. Because economists, whether they're liberal, conservative, progressive, they think that the stock market is channeling money into productive investment. It's not. It's a way of taking money out. A venture capitalist calls the stock market its exit strategy when you list on the stock market.
Yeah.
So they had it all wrong, but everybody thought they had it all right. And this basically, once Jensen started making this argument, I saw the MBAs all gravitate toward this argument. It wasn't that he had created the context in which it happened, but he now was articulating that context was fine. Executives said, okay, why should we compete with the Japanese? We can just get our stock price up and we'll get our stock-based pay, we'll get rewarded, and we can even get our stock-based pay higher because now we can do all these buybacks to keep our stock price up. And when some companies started doing this, other companies started doing it. And that's true to this day. Doing buybacks is a kind of a competitive process to keep your stock price up. There's some companies that can do it, massive amounts like Microsoft and Apple, and still have lots of money left over. Most companies can't. But even the ones that do, they don't invest in the products of the future. So one study we're just finishing now is, which we work on quite a long time and hopefully get done in the next few months if we have time, it has a title, Why Isn't Cisco Huawei? Okay, Cisco's system should be Huawei, or should be part of a consortium in the United States, which could include Microsoft, Apple, Qualcomm, Google, which is bringing the most advanced 5G to the United States. Okay, that's coming from Huawei. It's not because Huawei stole our technologies. It's not because of Huawei's controlled by the Chinese government. It's not because of manipulation of exchange rates. It's because Huawei is what I call a retain or invest company. It's not listed on the stock market. And it's a company that has had joint ventures. It's actually used IBM, which is a highly financialized company, but it's used them to learn management practices. And it's a hugely innovative company. And if we want to say, why are they leaders? don't blame them, blame us.
Well,
And
this is my point, Bill. But this is the whole thing. It seems like we've gone from a so-called value creation to really an economy. Because I've written a number of books on this stuff, but to value extraction.
that's right, precisely. And it's, by the way, a lot of people will call it short-termism, long-termism. I find short-termism to be a rather vague term because you can have someone who will, okay, Warren Buffett might hold his Apple shares for 10 years, or whatever. He's going to get paid dividends. Apple, since he's bought his shares, he has about a $37 billion, it's Berkshire Hathaway has a $37 billion stake. It was originally a $37 billion stake between 2016 and 2018. Apple's averaged about $55 billion a year in buybacks since then. Warren Buffett's is on a record. He loves buybacks because it increases his share of Apple without spending a penny or a dime, he said. And the value of his Apple shares has doubled. He has nothing to do with that company.
But I have a question for you, though, Bill.
What was that?
Well, I have a question, though. But hasn't this also really resulted in a very high concentration of wealth and
absolutely.
Huge economic inequality? I mean, that's and that's I think we're just as bad as we were prior to 1929. I mean,
we're worse. Yeah.
We're worse.
This is and so this leads to So back to buybacks. Let's get into about what they are. Okay, so there are you can buy back your stock through a tender offer. That's not actually what's covered by 10b-18, and that's not that's not what we're talking about here. A tender offer, let's say a big buyback, would be Michael Dell when he took Dell private in 2013. Now, in that case, that was a really good idea. He was doing all these buybacks to keep people like Carl Icahn at bay. And he said, I don't want to deal with this. I'm still a young guy. I built up this company. It has my name on it. He borrowed a lot of money, took it private, and as far as we can see, has really turned it into a much more powerful technology company than it would have been selling what had become almost a commodity at the time. Okay, you have other cases of buybacks where you might be taking the company private and then trying to tear it apart. This is what Mitt Romney sort of became famous for at Bain Capital. That's actually Eileen Applebaum, who you say you're having on there. She wrote really a great book with Rose Bott on this, on private equity. Okay, but buybacks basically are open market repurchases. The company just instructs its broker, go buy back a certain amount of stock, and at any point in time. Again, it was never illegal, but the SEC was always suspicious that it was manipulation. And in fact, there were certain rules, and still are certain rules, that when you have a stock that's in the process of being issued, or let's say you have a merger in process, that you can't do buybacks at that point. Okay, but in general, they then said you can do buybacks again if you stay within limits. It's 25% of your average daily trading volume on any single day. You can do that day after day after day. And as I said, for Apple, which is extreme, it's over $3 billion a day. They can do day after day after day. Also, we don't know when they do it. The SEC doesn't know when they do it. So there's insiders who have access to that information. But when they start doing it as persistently as, let's say, Apple does or Microsoft does, billions a year, and Apple keeps breaking the records. It's been up to 73. It might this year probably be fiscal year might even break its record of 73 billion in 1 year. Basically, if you buy Apple stock, you're saying every bit of profit they make in the future is going to come to me because they're going to pay it out in dividends and buybacks, and they're going to support the price of stock first priority above everything else. No questions asked. And there are no questions asked. Okay, so that stock price is going to have a high price. They can do that until they can't. And we can find lots of companies that do it until they can't. IBM did it until it basically lost competitive advantage, didn't get into cloud computing. HP is another company still making money on a number of its products, printers, etc., but no new innovation. Cisco mentioned. Cisco is a big company because cloud computing, call centers, etc., have grown, but it is still an enterprise router company. No real innovation at Cisco, and it was positioned to actually be a world leader in carrier class equipment. In fact, its movement into that space in the late 90s and early 2000s is basically what killed Nortel and Lucent, because they tried to emulate Cisco and they couldn't. So they crashed and burned trying to be like a new economy company. But Cisco actually didn't pick up the ball. What they started doing is doing buybacks and just supporting their stock price.
Would you, I have a question.
Yeah.
Would you consider, I almost consider some of this as malinvestment, Bill, because I mean, I have a small business and I know that I have to throw my money back into technology and what have you. And, and if you want it to grow, and you have to have a cushion, and I eschew debt. But wouldn't you say, I mean, I see, well, the reason I see this whole buyback thing is really contributing to economic inequality, because I see a lot of this kind of silly, like, for instance, General Electric, I mean, which was the largest industrial company in the world. It went, I think in 2000, it went from like a $600 billion market cap down to like 59 billion today. I mean, they blew, between 2008 and 2017, they spent 53.9 billion repurchasing their shares at 26 bucks a share. Was it like 660 today, whatever? And so what value did that have GE when they have all these pension liabilities and long-term care liabilities? And I mean, it's, my point is that it's kind of getting out of hand. I mean,
So let me just actually, I can illustrate some of these issues with GE because it's a very important company. Obviously, it goes back, of course, to 1872 originally, then became GE in 1892, and was a world leader, of course, originally in power equipment, and built the GE Labs in 1903, and became a world leader in medical equipment, in jet engines, mainly because it was given the British jet engine. The Whitley engine was called in during World War II, and it was able to develop it because it had been doing gas turbine research for over 40 years. Okay, so you got GE as a highly innovative company, and it, first of all, part of GE's problem was it came into the post-World War II era with all these industrial capability, but it had been making so much profits in the late 20s from light bulbs. Now, light bulbs were still in the late 20s something that people won Nobel Prizes for. There's a guy at GE named Irving Langmuir who won the Nobel Prize, I think, in the early 1930s for getting rid of blackening in bulbs, But so this was they were at the cusp of bringing new things to light, as they later say. Okay, but they had so much profits. They were paying their workers well, who were mainly skilled workers. They were paying out high dividends. They had very good management who believed in investing in the company, that they went into the appliance business. Now, GE had no real competitive advantages in appliance other than maybe a brand name. But what that ended up doing was after, from the 40s into the 50s, the people running this technology company were really ad men. They were people who were selling consumer products, particularly a guy named Ralph Cordner, who had come from Schick Razor, which was not particularly high tech. There was electronic, but not electrical, but not high tech. And they started becoming an unwieldy conglomerate in the 50s and 60s. And they were the ones that, at their management school, put out the notion that a good manager can manage anything, which was taught in business schools in the 1960s. and became a basis on which a lot of conglomeration went on, which ultimately failed. And that's what happened with GE, although it was coming more internally. They just bought up all kinds of unrelated businesses.
It was a
So
bank, though. Wasn't it
Yeah.
a bank? In the bank, in the end, it was a bank. It was the sixth largest lender in the world.
Well, but that's by the time you get into the 90s and 2000s. Yeah, but at the time, yeah, there's tons of money there, but it was just buying up every kind of business. And then when Jack Welch became CEO in 1981, now Jack Welch was a guy who had a PhD in plastics engineering. He was not a finance guy, but when he became CEO, he looked at this company, and he had grown up in that company, and said, we're only going to stay in industries in which, famously, he said, which were number one or number two. Well, you could take power, jet engines, and medical equipment, and you were number one or number two.
Yeah.
Those are still the industries that where GE is a leader. You know, and they had been around for decades. So what it meant was just getting rid of a whole lot of things. So what Jack Welch did, and he never really used the notion of shareholder value. Actually, when he was CEO up to 2001, the annual reports never talked about maximizing shareholder value. But what he did do was he laid off lots of people.
Neutron Jack, they call him.
Neutron Jack. And that was a change in social norms in the early 80s. It went along with Reaganomics. It went along with the notion of the free market. And in some ways, what he was trying to do is trying to get a company that was more coherent. Okay. But the problem was that they were still making huge amounts of money. And as they were laying these people off, so they then put their money into, they bought Kidder Peabody, which had a big scandal. They were certainly not number one or number two, but they had GE Capital, which about 50% of their profits. They invested in a lot of other companies, and they did not ever get away from really this conglomerate status, although they always retained a lot of industrial capability. You know, GE however, is like now still a leader, although a falling leader in wind energy, mainly because it was able to buy up all the companies that were leaders in wind energy from the 1990s. Now, what Jack Welch did also, however, was to keep shareholders happy. Was he precisely hit his earnings per share targets every quarter. Now, you know, we don't know the exact days in which companies do buybacks, because the SEC doesn't demand that information, and it's only since 2004 that we know how much they did in any particular month. So GE would just reveal how much buybacks it did for a year, and it actually even tried to obfuscate that by giving net buybacks rather than gross. Any case, he was hitting, there's no doubt in my mind that he was hitting those targets by doing the necessary amount of buybacks as you came to the end of each quarter to hit those targets precisely. So this became almost like a game for him. And it also allowed him to maintain control and have his reputation and have, you know, a huge amount of pay, etc. I think it was in many ways also kind of an ego thing. I think it goes, some people have written about Welch say, you know, goes back, he came from a working class family from around Lynn, Massachusetts, and he was passed over in favor of someone else for a scholarship to MIT. So he went to UMass Amherst, and he never forgot that.
The point is, they spent $54 billion, Bill.
Yeah.
And it's at $26 a share, and now it's $6 a share.
Yeah.
I mean, it's just
Okay. So now, when he left, however, by the time he left in 2001, the people who took over, they were just brought up thinking shareholder value, including someone like Jeffrey Immelt. Now, Immelt came from the medical equipment side. So Immelt knows innovation. And here's one of the things, that some of these CEOs are just doing financial engineering, nothing else. Some of them, like Tim Cook, he's a supply chain guy. What's he going to know about investing in the technologies of the future? He really doesn't. he might pretend he does, but he's no Steve Jobs. Immelt, I think in a company like GE, there was actually a conflict between, are we going to innovate or are we going to be financialized? Are we going to just boost our stock price? So they had enough money in the first 6 years that he was CEO to do both. And buybacks took off between 2003 and 2007 for all companies, and GE was in the lead. But then there was a case where they did it until they couldn't. They did a lot of buybacks in the first half of 2008, and then GE Capital almost drove them out. Well, they were certainly threatening their credit rating. So they actually sold stock at about 2/3 of the price in late 2008 to keep their credit rating, so they didn't have to borrow the money. They then slowly started doing buybacks again, but they were also trying to innovate. They moved to the Boston area. I think that was to tap talent. There were some people around Immelt who were trying to innovate, but they had a vulnerability, and it wasn't just that they were open to doing buybacks. The institutional structure evolved in the United States, and we have this in a book that I wrote with Jang Sup Shin, who's a professor in Singapore from Korea originally, called Predatory Value Extraction, came out last January. Basically, we have a proxy voting system that allows a shareholder activist to have maybe 1% of the shares and mobilize the votes of the institutional investors. And even if they don't win a proxy fight, threaten the company enough so that if it doesn't do enough, what they call returning value to shareholders, the CEO is going to be out of there.
I have a question for you. But GE really turned into a bank, Bill. I mean, they made a lot of stupid purchases. One of them being when they bought Weyerhaeuser Mortgage Corporation from Apollo Global Managed for $500 million. I think.
Oh yeah. No, I think they never got there was a lot of just
stupid.
You actually almost have to look at each acquisition that these companies make, that every major acquisition, to see that it makes sense or not. I mean, Hewlett Packard spent about $9 billion on a software company in UK called Autonomy.
I remember that one, yeah.
Yeah, no, it wasn't a foregone conclusion that was a bad, investment, but it turned out to be bad. You only can understand it in the context of that company and who was leading it and what they understood about the company. Microsoft, they bought the Nokia cell phone business.
Oh yeah, I remember that.
Yeah. So you see this going on all the time, and in part, this is obviously a failure of management. In some cases, they are doing acquisitions just to, milk them dry. This happens in the pharmaceutical industry a lot. So, but I think the bigger problem was that in October of 2015, given that GE had always been this company that was trying to boost its stock price, and that Jeffrey Immelt would, unlike Jack Welch, he would be talking shareholder value all the time, while at the same time saying we're going to innovate. A guy named Nelson Peltz or Trian Partners bought 0.8% of their outstanding shares. He just came off of having about 2% of DuPont shares, losing a proxy fight, but winning there by driving the CEO out. And by, they then ended up with another hedge fund guy who took over DuPont, Dow, merged them, stripping out R&D, etc. These people, they know nothing about these businesses. They care nothing about these businesses. They care about getting the stock price up and cashing in. Okay, so Immelt bought these shares, still a couple $2 billion, and put out a white paper about how GE had to change. they got Immelt, a quote from Immelt to put on there how this was a friendly investor, et cetera. They didn't really invest in them. They just bought shares on the market. And then in 2016, GE, and actually because of problems with GE Capital, had lost money in 2015, but it had an $8 billion profit in 2016. It did about 8.5 billion in dividends and 22 billion in buybacks.
I know,
And
24, I think it was 24, was it? I mean, then it doesn't.
yeah,
But they
so
did this, Bill, when they had all these pension liabilities and long-term care liabilities and all
yeah,
that stuff. I mean, it's just, I mean, if I'm running a business, I mean,
yeah.
I mean, it's kind of crazy.
So then at the beginning of the following year, 2017, you hear rumors that Peltz, after all, who just has 0.81% of the shares, he doesn't think that Immelt's done enough to get their stock price up. So out goes Immelt. He says he retired, but he didn't. He was kicked out. And then Tryon or Peltz puts one of their guys on the board. And then the following October 2017, the Wall Street Journal reports, GE's missed its dividend payment only the second time in 100 years. The last time was in 2008, the only other time. Well, what do you think? They over $30 billion in distributions to shareholders and $8 billion of profit after you hadn't been profitable. You're trying to move into some new industries and restructure, in a new headquarters, et cetera. Yeah, so they've been downhill ever since. And there's, it's destroying a company like that. It doesn't fall apart all at once because it still has valuable assets and is producing products that people are buying, but it stops being the innovative company it was. And in this case, I think Peltz and his group didn't do all that well because they pushed it too hard and it couldn't be sustained. It wasn't. It didn't have the staying power of an Apple or a Microsoft. You can find other companies where we wrote about recently about Exxonmobil. So Exxonmobil was the largest repurchaser of its stock in the period of around 2015,
Yeah.
13 or so. And the biggest value extractor was Rex Tillerson. It
Yeah.
was absolutely appropriate that Rex Tillerson should go from there to the Trump administration, also because his area of influence was in Russia at ExxonMobil. But they were doing about 22 billion a year between when Tillerson was the CEO for about 11 years, from 2006 to 2017, or the end of 2016, and they were doing about 22 billion a year. It slacked off a little toward the end there, but they, of course, all you need to see is that oil prices were enormously high, and they were just raking it in on that and doing nothing else. He was meanwhile downsizing, so I call it downsize and distribute. A perfect example. I forget the numbers, but it went something like maybe 84,000 to 71,000 people while he was there, while he was doing all these buybacks. Okay, he left, oil prices were way down. ExxonMobil can't do any more buybacks. Their CEO was asked about this in an interview several months ago, I think in the winter. Said, when are you going to do buybacks again? He said, well, we're trying to sell off or something like 15 billion in assets, and then maybe we'll do buybacks with that money, or I forget the amount. But in any case, they hardly can pay their dividend. Why? Because they haven't invested in it. They have oil. There's the demand for oil is down. The price is way down, and that's all that company is. And of course, the other thing, which is we know about ExxonMobil, is that they did some of the pioneering research in the late 70s about the problem of climate change, and the need for the dangers of the product they were selling, and they hit it. They hit it from view, and then actually funded climate change deniers. So there's a company that just had a dominant position and enriched a bunch of people, and we're left with very little. And the other thing is that buybacks are different than dividends. So if you, I mean, shares are very unequally distributed across the population, the economy, even through pension plans. There's different figures out there, but one is that 10% of the wealthiest households have 84% of the shares. It comes from a guy named Ed Wolf from a few years ago.
Yeah.
But basically, when you pay a dividend, you pay it to every shareholder. And they have an income, and if it's in your pension, it's tax deferred. And I always say to people, well, if I have a company that's paying me dividends, I don't want them to pay 100% of dividends. I want them to be of their profits dividends. I want them to be reinvesting, because some point I might want to sell the shares, and if they don't reinvest, those shares aren't going to be worth much, like an Exxonmobil. So you should not, as a pension fund, in terms of what your clients want, or mutual fund, you should not want companies doing buybacks. But the pension fund managers, there you do get this kind of short-termism. They're under pressure to compete in terms of getting the going, yield quarterly by quarterly, and so they look to the hedge funds. They look to people who are active as investors. They look to derivatives, et cetera, to try to get that yield up. And now buybacks just the gains all go to those who sell the shares.
Which are
That's how you make money with
mostly.
buybacks. You're paying people, giving them a price boost, and if you can time the selling of the shares, if you can hold get the company to do a lot of buybacks, boost the share price up, and then figure out when to sell the shares, you're going to make a lot of money. You don't invest a cent in the company. All you're doing is just buying the shares, getting to put all this money on the stock market. And if you have inside knowledge, you can try to figure out the best time to sell the shares. And that's what a lot of Wall Street is now, is people trying to figure out, when to buy and sell. The timing is everything. And that's why, hedge fund managers and corporate executives, given the way they're paid, love buybacks, because you make your money as share sellers, not as shareholders. And as a fundamental difference, I think if talk about who knows what, if people who are really believe in shareholding and getting a yield on their shares from shareholding really understood buybacks, they would go and get them banned right away. They do them no good whatsoever.
Yeah, because this is the thing, Bill. And then you have the role of passive investors now. Like you have companies like Vanguard, State Street, BlackRock.
Yeah.
Fidelity, Invesco, most of them, they're all passive. I mean, there's no accountability, if you will. I mean, during this whole GE's, I think, I don't know, for a number of years, I think Vanguard's been the largest shareholder of GE for I don't know how many years, but
yeah.
But my point is that all this stuff, Bill, this financial engineering is really leading to just tremendous economic inequality. And that's when people ask me questions. What they say, Barry, what's causing this? And I say some of it's buybacks, and just like your friend Eileen Applebaum, who I think is just a wonderful lady, the buybacks are almost akin to the dividend recaps, Bill, where companies remortgage the balance sheets and they pull out a debt-funded dividend. I mean, they're somewhat analogous. Would you agree?
There's two basically ways in which you can engage in what I call predatory value extraction. One, as a publicly listed company, when you do buybacks and you are a financial interest to its position to capitalize on that. And I've written a lot on executive pay, and executive pay is certainly structured to allow executives to realize gains on buybacks, and they're the ones who make the decisions about the timing of buybacks. Certainly, hedge fund managers, Wall Street bankers who are in the business of trading, that's their business to try. They don't always get it right every time. There's other things that happen, but that's one side of it. The other side is engaging in this predatory value extraction when you take a company that's vulnerable off the market and then load it up with debt, pay yourself a dividend. If the company can survive and you can get it back on the market, that's kind of gravy. But you're covering yourself, and of course you're laying off people. You're basically looting the company for the sake of private equity. And it's not that every private equity firm does that. There are private equity firms that, like the ones that backed Michael Dell, that are trying to invest in.
Well, he did dividend recap for about $1 billion, though. He did one for about $1 billion. But my point is, like Neiman Marcus, they did dividend recap with PIK notes, which is
but you can do that. That's But the question is whether you might be doing that, but you might be trying to balance it with also building up the company. There's a lot of cases, and Eileen Applebaum and Rosbach have some of them in their book, and you can read about them I think the book now came out about 8 years ago, but you can read about them in time to time. There's investigative reports where there's nothing but just taking the company private, laying people off, getting rid of their pensions, loading up with debt, and just putting that money in the hands of the private equity firm. And if the company crumbles to the ground and people all lose their job, nobody really cares. So, and the difference is that that really is done out of sight, in the sense that there's less disclosure of what you're doing as it's going on than there is with a company listed on the stock market. But on the other hand, it's sort of like Donald Trump has proven to be the case, that you can you commit crimes in plain sight and nobody really cares. And so that's what the public companies have been able to do with looting of the companies through buybacks. Basically, they're stealing in plain sight, but it's permitted. And as long as you let that be the law of the land, well, people are going to go and get away with it, and we pay the price. But there's no doubt in my mind that this is where value is created in these companies, and it's a tremendous amount of value. It is a source of where you can get a strong middle class, where you can get people who have stable employment, get promotions, get higher pay over time. And if you start saying, no, that doesn't belong to you, that all belongs to shareholders, who after all are just people who are buying and selling shares, and just ripping all that money out, then you're going to get vast inequality. It's going to be two sides of the same coin: concentration of income at the top of the income distribution, and the loss of middle class jobs. And of course, the same companies that are doing this will say we need lower tax rates in order to be competitive, but what they mean is we need lower tax rates to do more buybacks. They'll say, like in the pharmaceutical industry, we have to charge high drug prices because we're investing in all this innovation. But we documented this. The companies get high drug prices and use it to boost their stock prices. So it's all value extraction, not value creation. This is the way it's working in a lot of different industries. So there's a lot of behavior: tax avoidance, price gouging, laying off workers, reneging on contracts, etc., that goes along with doing buybacks. It's part of a practice of getting your profits up in order to rip them out. And there's nothing wrong with profits. We need profits. We need profits. But we need companies to reinvest those profits, and we need actually a totally different theory about who creates value, and who doesn't. And part of the problem with shareholder value ideology is that it actually says the people who matter most are the people who matter least.
Because as you know, anyone turns on the television today, Bill, I mean, we're seeing riots today, around the country like we've never seen. I mean, since remember during the Vietnam War when we saw real riots, and I remember that time. But now I think this is just my opinion, that a lot of these protests are really kind of driven by people are frustrated. When people lose everything, they have a tendency to lose it. I mean, so I mean that's what I think if people were making really good jobs and didn't have such huge student loans and things like that, you would see a lot less of that. That's just my point in all this.
Oh, absolutely. And as I said, we're doing this. It's coming out. This book we've written on what happened to African American employment under the Equal Employment Opportunity Commission, so that in fact there was this limited upward mobility into blue collar middle class for blacks in the 60s and 70s, and that was partly because there was still a strong demand for blue collar mass production labor, which was still highly unionized, and a lot of white through intergenerational upward mobility, their children were going into college and not taking the blue collar jobs. The people who were coming, like the Latinos coming into the country, tended to go more into agriculture. And so you had a very high representation of African Americans in, let's say, doing semi-skilled operative work in the automobile industry, which paid a good middle class wage. And that all started disappearing in the early 1980s with Japanese competition. The ability to pay blue collar workers with just a high school education as much as they had, that actually changed. There's no doubt about that. It wasn't automation at that point. Later on, it became automation. It was mainly more Japanese competition, and it wasn't low wage competition. It was competition that was much more productive, that what we talked about earlier, putting skills on the shop floor, integrating them to the organization. And in the United States, basically the response to this of many large companies, and this is reflected in GE laying off lots of people, reflected later on in IBM, was just to say, we're not going to compete in those manufacturing industries. And so they just stopped. And even in the 80s, you have plant closings. It is a generally prosperous decade. Plant closings all over the place. You have layoffs in the late 90s. Because the new economy model, the one out of which you get Intel, Microsoft, Cisco, et cetera, they actually didn't do manufacturing. Intel does, but it did high-end manufacturing. A company like Cisco never did manufacturing. So you then had a whole group of the labor force, which included whites and blacks, who now couldn't get the incomes that they used to get. And so what you had to do was use the profits of companies to pay taxes, the profits of rich people to pay taxes, to recommit to spending money as had been done in the past on higher education, on upward mobility. You would have, if you had really been serious about that, you wouldn't have student loans with extortionate rates on it. You would have subsidized people to go to college, as has been done, for example, under the GI Bill. But the opposite was done. And basically, I think a part of this was racism, and that is that the white people didn't want to now fund the upward mobility of black people. But I don't think they necessarily thought of that way. They found an ideology that said, oh, you don't need to do this. And that shareholder value ideology was saying, no, we can make money through financial engineering. We can make money out of money. And that's good. There's no problem with that. So actually a lot of, let's say, highly educated, let's say, white Americans who would have gone into science and technology started going to Wall Street. That's where you get the quants. Okay, but actually it turned out we didn't end up having a shortage of people for the STEM occupations for high tech, mainly because Asia had been growing through educating all its labor force. Some places more evenly than the other, India very unevenly, but other places like Korea, everybody's getting educated. Taiwan, everybody's getting educated. Not all those people are going on to higher education, but we're getting a lot of those people from the 1970s. And we start changing immigration law in 1965 and particularly in 1990 to allow the most highly educated to come in. And they are upwardly mobile. For a while at least, although it's surfacing now, all of a sudden the racism kind of somewhat disappears because these people become essential for the high-tech labor force, and they do very well, as they should. But one of the results of this is that high-tech and business leaders and the people they elect in government, they can say, well, why do we even have to care about this old blue-collar labor force? And what we found also is that in one way they got away with this is that the white blue-collar labor force, they got hit after. The blacks got hit first. They were kind of last hired, first fired in the 80s. In the unions, they protected seniority, so they got lots of benefit for their most senior workers. they tended to be more white than black. But eventually it all came home to roost. And you
Now,
had
Bill,
downward mobility, not just for working class blacks, but working class whites. You have, over the last number of years, declining life expectancy of white males with less than high school education. And in some cases, they might see themselves as being in the same boat as black workers. In some cases, depending on how they look at things and who's fomenting, striking fear in their hearts or whatever, they see the black workers and brown workers as somehow the people who are causing them to be downwardly mobile. It's not the case at all. It's the failure of the system to continue to invest. And
I would agree with you on that 100%.
Yeah.
I don't see it as I have black friends and so forth, but I see it really as more of the economic destructions of of good paying jobs, or the absolute you're in Cambridge, I'm up in New Hampshire. The price of real estate here is ridiculous now. My point is that a lot of this financial engineering, if you study history, what brought down Rome was not the collapse by the barbarians, it was the collapse of the currency. And so my whole kind of a fear is that what we're seeing going on here is really not value creation, but it's value extraction.
Oh, absolutely. It's absolutely. And we call it predatory value extraction because the people are extracting okay, if I go and work at a job and I help create value and then I extract it through my wages, there's a balance there.
Yeah.
But if you have the people who are taking all the money out or the people who put the least in, then you got a problem. So, just one example, we have it, it's again online at the Institute for New Economic Thinking a few years ago when Carl Icahn had bought $3.6 billion of Apple shares in the summer of 2013, started demanding that they do huge buybacks, get the stock price up. We went through, we traced what he did. He held the shares until the winter of 2016. And we then said he ended up in the end out of the 3.6 billion. I wouldn't say he made 2 billion because he didn't make it. He took it. He was able to get it because he never contributed a thing to Apple. He just bought their shares. But first of all, during the 2 full years that he held the shares in 2014, 2015, they did the biggest buybacks in history. So that helped boost the share price up. Okay, so from point of view of how did Icahn, work this, that he turns his 3.6 billion into 5.6 billion after about 30 months. So the first thing was the wealth. Actually, he had that money. It wasn't even anybody else's money. He could put it in from 2011 by doing this predatory value extraction and winning enough times rather than losing, which he did sometime. He was able to get rid of other people's money, just have the only money that he was directly in Icahn Enterprises invested. The second was his visibility. As soon as he bought the shares, he let everybody know. He said, "Hey, I'm here to get these share price up. You institutional investors, you're underinvested in Apple. You better get in like lemmings, and that'll get the share price up." And he was tweeting out stuff about this. Invited Tim Cook over for dinner, tweeted out that he told him to do 150 billion buybacks. His stuff should have been illegal. Anyway, that's the second thing. The third thing was the hype that he put out. He started putting out all these projections of all the money that Apple was making, assuming that every single dollar that Apple would ever make belonged to shareholders or should be in the current stock price. Those papers were wildly, he could have said anything. He was just hyping the stock. The fourth thing was reflected in bringing Cook over he was always talking about, I just spoke to Tim and the board. He like that, his influence. So he can influence them, obviously. And I think they were afraid of him. I think this is one of the reasons they do all these buybacks, just because they're worried that he's going to use the proxy voting system, which is very corrupt, to take it over. Okay, the last thing that he did, which seems quite obvious, was probably he had inside information. So what happened was that he was holding these shares. We were following it. It was the winter of 2016. And toward the end of April, he gave an interview just after Apple had released its quarterly report from January to March. And he said that he had sold all his Apple shares. And they asked him why. He said, because Apple's having problems in China. Okay, so then we did a search of all, search engines, Factiva we use, LexisNexis, all these things. We couldn't find any news out there about China having a problem and Apple having a problem in China before March 31st, before the end of the quarter. But we do know once the quarterly report came out that they're actually sales had fallen quite a lot in China. It was the first quarter-on-quarter decline since 2003 or something like that. So then we had to wait until May 15th to see when Icon sold the shares. Did he sell them maybe the day after the annual report came out? No, he had sold them all by March 31st. So somehow he knew that there was a problem in China, but no one else did. And Tim Cook probably knew that. I mean, obviously knew that. He was getting his information somewhere. So that's the way it works. And now on the other side, we then did a calculation. We said, okay, he came away with a gain of $2 billion. If he had really been able to know exactly when that price was going to hit its peak, it was actually the end of the previous April. And if he had sold right at the absolute right time, in retrospect, his gain would have been exactly double, 3.6 billion rather than 2 billion. So he doesn't know everything.
He didn't go for the empty pill, but my whole point of this bill, and this has been great as we kind of wrap it up, but this the S&P, I said there's been about 5.3 trillion in share buybacks over the past decade.
Yeah.
My question is, and this is the subject of your first paper, they manipulate the market and they leave most Americans worse off. Is that, you still hold
Absolutely.
that?
Yeah.
So because people ask me, Barry, why is all this economic inequality? And I'm saying, well,
Yeah.
one of the reasons is buybacks, and I mean,
absolutely.
And you would still agree on that,
Oh, absolutely. Yeah.
So what do you think? What's the solution, Bill? If you had metric one, what would you do?
Well, in some ways, part of the solution is very easy, and that is that if you have the right people in power, they should recognize that in November of 1982, the SEC made a very unwise decision in Rule 10b-18 that, in fact, this has caused great harm to the U.S. economy. It was based on a bad theory, a false theory of how investment occurs. It was notion that it's all this money just flowing through financial markets rather than companies retaining or investing money. You would have recognized that. And so you rescind Rule 10b-18. And that's actually part of a bill that Senator Tammy Baldwin has introduced first in March of 2018, introduced again in March of 2019, to rescind Rule 10b-18 and to have representation for workers on the boards of companies, kind of German co-determination style. Now, on the second part of that, I think there should be different representation on boards of people who are the value creators. My one big concern would be that if you just took the general understanding of these things among the labor movement in the United States, which has just been largely passive in response to these issues, that they would not really come in with the firepower on boards to get things back on track. There needs to be a much greater re-education of the labor force. And also, I think it's really much more, rather than a labor issue or a consumer issue or a taxpayer issue. I mean, as a taxpayer, since we fund the infrastructure and knowledge these companies use and they then argue for lower tax rate, maybe I want some representatives of mine on the board as a taxpayer. We need a much more of a trusteeship model. And the people who shouldn't be on the boards are people like Carl Icahn, Nelson Peltz, William Ackman, all these predators, Paul Singer. They're just predators, so this requires a dramatic change in the way in which, never mind people who don't know much are informed, but people who should know better think about things. And this includes most economists I know, includes most people at business schools that I know. They have to start people who are, have a lot of brain power are making these nonsensical arguments. So somehow we have to, what we've been discussing to say, we have these problems that everybody can see it around us, and we don't want to have these problems. How do we get rid of them? Now, I think, again, there have been some Democratic politicians and actually some Republicans who have spoken out against buybacks. But then what their solutions are is another question. Joe Biden was actually someone who was very taken with that article of mine after it came out. And I met with him a couple of times in 2015 about it. And he even wrote an op-ed where he cited it in the Wall Street Journal in 2016 about the need to have reinvestment in the economy. Right now, it's not an issue actually that's being raised on the Democratic platform. I think there's a kind of a skittishness about attacking the stock market at this point in time. Because actually, if you started arguing that you should just stop buybacks, you'd probably
Well, it's 50% of the market activity now, Bill. I mean, I've looked at the numbers. 50% of the market activity is corporations buying
so I think there's
stock.
a definition, so we'll see what happens. We'll see who gets elected, what happens after election. But I think at that point, I mean, we're still doing our work on a whole number of fronts on this stuff. But at that point, I think people have to, that's something that, and it would be easy to do because it's not bad for shareholders who are really shareholders. Pay a reasonable amount of dividends, have companies reinvest, have people be employed so that they can actually build up their pensions.
Well, they have
it's a win-win situation, except for the predatory value extractors, and it puts a different type of person on the head of companies. And frankly, some people who are running companies might like to have this a change in regime. There was just it's interesting because I'm just with a colleague of mine named Omer Tulum. We are just finishing an article, hopefully be available in a week or two, on two big British pharmaceutical companies, GlaxoSmithKline and AstraZeneca. And those companies became very financialized. They were doing lots of buybacks between about 2000, 2010, a little beyond that, even 2013, 14. And then they were going nowhere. They had a change in regime and moved away from financialization back towards innovation. It turns out that the shareholders who were influential in the UK are somewhat different than what's influential in the United States. And in this case, they pushed them back toward actually investing. And at AstraZeneca, there was just an article, really good article in Fortune, which could have been written, actually, we've done the in-depth research on the company, where it talks about this, it came out just this past, I recommend it, came out just this past week, I think, on this turnaround of AstraZeneca. And the CEO there is Pascal Soriot. He came through Roche, the Swiss company, and he has a statement in there that could have been just right out of something that, like my Harvard Business Review article. I don't have it in front of me, but he basically said when he came to the company in 2013, he says it was being run like a spreadsheet. And company, they were just looking for a way to cut costs. They weren't, doing any innovation as drugs, were falling off the patent cliff. And all they wanted to do was a big buyback to manipulate the stock price. That's what he says. And he said, we stopped doing that. And, there you have it. I mean, you can turn these companies around if you have the management and the people running those companies who realize that's not why you're running these companies, to run them in the ground for the sake of people who are just, selling the shares. Now, Pascal Soriot, he'll do fine, because the fact is that even if you have the stock market actually does reward innovation as well. And if you have shares that are actually being rewarded by innovation, you may make as much money as you make having your shares being rewarded by financialization, by value extraction, by propping up your stock price. It's just that the people who are propping up the stock price, those CEOs, they probably don't know how to do innovation.
No, they don't.
So it really matters who runs these companies. I mean, that is of critical importance. What their abilities are, what their incentives are, and who's on the boards, and that varies differently. Even a lot of people used to lump, still do, Britain and the United States together as shareholder value, corporate economies. But Britain actually is a little different. It's not as innovative as the U.S. It doesn't have as much in the way of profits, but there's actually is more room in the U.K. to move back towards innovation than we've seen in the U.S.
Bill, our time has come to an end. Where can people find more about you, and when's the best? This has been great.
So a lot of the research is on the website of the Institute for New Economic Thinking. So if you just Google that and my name, you'll come to a whole set of pages with a lot of research by me and my colleagues. I run a nonprofit research organization called the Academic Industry Research Network. We have actually a lot of stuff on our website, but we've just let's say a couple weeks away from relaunching the website, redesigned. And so, but if people could look there, there's the old website is still the one that's live, which is a little out of date. There's a number of articles that I wrote besides the one you mentioned, shorter articles on Harvard Business Review website. You can find them there.
There was a great one in the New Yorker and a couple other places.
Yeah, and then there's a lot of people who've written articles about this work that you can find. So it's pretty easy. I mean, just Google Lazonick buybacks, you'll find lots of stuff.
He counted on America to be passive. He counted wrong.